Companies turning away from China. Let's have a look. Hello everyone, Florian.heise here and welcome to another episode of HeiseSays. Grab your stein of coffee and let's have a look at this news.com.au article mentioning Asia Pacific companies keen to bring manufacturing back onshore. A large number of businesses across the Asia Pacific are looking to minimize their reliance on China as trade tensions worsen, a new report has found. And I thought this would be a good time to discuss the topic of sovereign risk. Now, if we jump over here to one of my favorite websites, Investopedia, we can look at sovereign risk. So, what is sovereign risk? Sovereign risk is the chance that a national government's treasury or central bank will default on their sovereign debt, or else implement foreign exchange rules or restrictions that will significantly reduce or negate the worth of its forex contracts. So some of the key takeaways. Sovereign risk is the potential that a nation's government will default on its sovereign debt by failing to meet its interest or principal payments. Sovereign risk is typically low, but can cause losses of investors of bonds whose issuers are experiencing economic woes, leading to a sovereign debt crisis. Strong central banks can lower the perceived and actual riskiness of government debt, lowering the borrowing costs for those nations in turn. Sovereign risk can also directly impact forex traders holding contracts that exchange for the nation's currency. And if we jump over here, let's have a look at just all of the different countries around the world and their sovereign risk. This is the S&P Global Ratings and the 2020 estimates. And we have ratings from dark green is AAA, and that's Canada. We can see here. The LTFC rating is AAA. Then you've got the United States. They're AA+. So Canada has a lower sovereign risk than the United States. Good old Australia, we have a AAA rating for now. And we're doing better than our friends across the channel. Not quite a channel, little tiny ocean. But they really should just join the Federation, shouldn't they? They really should. You can see I want that economic complexity up. But their rating is AA. If we have a look at some of the countries in our neighbor, Indonesia has got a BBB rating. So it's a fourth level of rating. Then you've got Papua New Guinea. It's a B- rating because it goes from, I'll close that. AAA, AAA, AA, triple B, double B, triple C. So they're pretty, PNG is pretty low with regards to their rating. So they're pretty high sovereign element of sovereign risk there. You've got Fiji, they're double B minus. So PNG is better than Fiji. The Cook Islands are B+. So we'll zoom back out here. Now let's have a look here. We've got Vietnam. What's Vietnam at? They're at double B. China is A+. So China is A+. What about Russia? Let's compare. So Russia is considered worse than China. They're triple B negative. What about Japan? They're A+. So China and Japan are the same. Korea is double A. So China and Japan are both A+. That's interesting. I would have thought Japan would have been higher than China. Mongolia is B. And let's look at everyone's favorite country that teaches us a valuable 21st century lesson that socialism still doesn't work. Venezuela. And they've got SD. There you go. Real GDP growth, negative 15%. Investment GDP growth, negative 5.18%. Percentage of population that have to eat their pets to survive, 85%. I added that one in. So let's have a look at this article about companies turning away from China. Their sovereign risk isn't the highest in the world. So a new report has found a majority of businesses across the Asia Pacific are actively reducing their reliance on China in their supply chains. The latest Asia Pacific CEO survey conducted by Westpac's institutional arm found a number of large corporations in the region had or were planning to bring manufacturing back to domestic operations to minimize risks within supply chains. Surveying 113 chief executives, the report found 2/3 of firms had experienced significant supply disruptions during the coronavirus pandemic, and more than half had decided to manufacture onshore. Over half, 57% of firms in the survey, had begun to onshore supply and or manufacturing in order to secure their supply, and more, 63%, expect to continue in this direction in the future, Westpac's survey said. Many CEOs are likely to see such measures as helping to reduce supply dependency on China. This shift coincides with fracturing trade relations between Australia and China, which has hit major exporters in the agricultural and resource sectors. The relationship soured further on Friday when China authorities slapped Australian winemakers with import tariffs of up to 200%. The Chinese government claims Australian winemakers have been illegally dumping wine into the Chinese market, which has lowered the price. The fallout has already had a material impact on Australia's largest wine producer, Treasury Wine Estates, which on Friday saw its share price tumble 11.25% to $9.25 at the close of the stock market. Westpac executive Anthony Miller said the new approach presented an opportunity to reinvigorate local manufacturing. We're going to see a focus on smart manufacturing, which will create jobs, particularly high-skilled opportunities. And it's going to see us building capability in areas which will be very competitive on the international scale, he said. The thing is, we're still not going to be able to make a silicon chip in this country, but then again, we can import them from other places. Westpac's report also highlighted a number of firms remain resilient during the pandemic and were able to adapt to changing demand and operating conditions. According to the survey, 69% of CEOs said they'd become more resilient as a leader, while 72% of respondents said organizational decision-making had become quicker. Mr. Miller noted prompt responses by senior management had accelerated digitization strategies, particularly using technology to cope with a remote workforce. A lot of businesses took actions to stabilize their operations out of urgent necessity, but in the process, many have brought in changes that promise future benefits, some unanticipated in terms of efficiency and team cohesion, Mr. Miller said. Westpac's report surveyed chief executives from 113 companies located in Australia, China, Japan, Singapore, Indonesia, and New Zealand. The survey was conducted in July and August. So there you have it. So you've got people from Australia, Japan, Singapore, Indonesia, New Zealand, and apparently China turning away from China, moving their manufacturing out into, well, you'd hope, locally, and probably to other countries in the region, to not be so dependent on China as a source of the manufacturing process. But you have to remember, everyone, we'll have to remember, just look at shipping heading to and from China. That's not going to end anytime soon. Not at all. I mean, look at that number. Look at those bulk cargo ships. Anyway, guys, let me know your thoughts and opinions. Do you think this will actually create more jobs here in Australia? My biggest concern is the NIMBY crowd, the not in my backyard crowd, the people who don't want manufacturing around their nice houses, the people who want power to be expensive in Australia and somehow think we can compete in a global environment. We'll have to see what happens. As always, thanks for watching. Please like, share, and subscribe to the channel. If you're a fan and want to support the content I create here, there are a few ways you can. You can join us on YouTube or Patreon. You can support us using our affiliate links at Amazon, eBay, Independent Reserve, or Kucoin, or AussieBroadband. You can buy a merch from HeiseSays or Teespring. You can support us using GoldPass or PayPal. Take care, everyone. Have a great day. I'll see you all in the next episode.